what can we expect the rest of the year? The market's rallied a bunch this year, and most of the rally has been based on the thought that the Federal Reserve is printing money, the European Central Bank is printing money, they're all buying bonds, they're creating all this money in the system. So stocks have risen. Well, the reason they've risen is because those reserve balances can be leveraged and then invested inside the stock market. Because who really, if you're a bank, wants to make a loan on a house for 30 years around 3% interest, when you could turn around and take that money on reserve, invest it in the stock market or the bond market, and make much more money than you would on a 30-year mortgage. So we've seen the rally in the market because of that. But like we learned in 2010, and again in 2011, and especially in 2008 and 2002, the simple fact that the Fed is cutting interest rates and they're creating money does not mean the stock market's going to be able to grow forever. If you'll recall, we've seen just since 2009 periods where the market got way ahead of the economy only to fall back down in line. Then it gets back ahead and it falls back in line. What worries me for the rest of 2012 is the market once again has gotten ahead of economic growth, yet we have a lot of things looming on the horizon. Number one, and it should be a concern to everybody out there, whether you have money in the stock market or not, is the so-called fiscal cliff. Now the fiscal cliff is a simple term trying to lump in everything that's expiring at the end of 2012. Whether it's the 2001 or 2003 tax cuts, the payroll tax cut, the jobless benefits, some of the spending cuts that are going into place, the alternative minimum tax adjustments that were made over the last 2 years. There's just dozens of policies that are set to expire that, according to economists, are going to add up to about a 4% hit in GDP if everything's allowed to expire. And the concern we have is if Congress remains partisan the way they've been and the way they were last year when we were dealing with the debt ceiling, it's going to be very difficult to get these things resolved before the end of the year. So let's take a look at why the fiscal cliff is so important and why it's going to be difficult to address. When you look at it, it's all about our budget deficit. Our budget deficit is just the amount of money the government has that's either above or below what they took in revenue. And as you can see, going back to the 1890s, our government pretty much always ran right around the zero line. Maybe they had a little bit of a surplus, maybe they had a little bit of a deficit, but they tried to keep it in line. The only two real dips that we saw until the last part of the century was World War I and World War II. But as you can see, they quickly got things back into budget and they paid back the money they were borrowing. But as you can see, beginning in the 70s, we started to run a budget deficit. And then as Ronald Reagan fought the Cold War, we saw an even bigger budget deficit. The only time we've seen a surplus was in the 90s, when we had Bill Clinton working with the Republicans in the so-called Contract with America. But as you can see, once the recession hit, we started running budget deficits that at the time were historical. And then we saw a bit of a recovery, yet we were still running a $200 billion budget deficit, even during the housing bubble. And then unfortunately, the housing bubble popped. And since that time, the deficit has swelled to $1.4 trillion. It's improved a little bit, but it's still in excess of $1.2 trillion. And it doesn't look like things are going to get solved very soon, because all the easy cuts were made last year. They cut some wasteful spending. They cut some areas of defense. They changed the rules a little bit on Medicare to make it look like they were saving some money. But when you look at the categories and the things they've cut, they haven't really cut spending overall. They continue to increase spending. This chart here shows that there's been very few times where government spending has actually dropped. Even with these spending cuts that they supposedly made, we're still seeing spending increase everywhere from 2% all the way up to 6 or 7% in the latter part of this decade. And more importantly, if you look at the red line, that's the percentage of GDP that the government spending represents. And you can see during the good times, back in the 90s, we were somewhere around 16 to 18% of GDP as far as government spending. But that, as we go deeper into this decade, we're going to be well over 30% of all government spending in terms of GDP. That's something that very few countries can maintain. And it's an area that needs to be addressed. And we're going to look at in a little bit why the spending will have to continue to go up under the current budget policies. But let's look a little bit at the budget. Let's look at 2013. I decided to look at each spending category inside the president's budget and break it off into a pie chart. And it's pretty clear, I think, to anybody, even if you don't understand math, to see there's three areas really that represent 2/3 of the federal budget. And that's security, which includes defense, homeland security, some CIA stuff, Department of Justice, I believe it. But basically defense is the biggest area of that. And then you have pensions, which is Social Security, as well as any government employee pensions. And then, of course, the big one is health care, which is the Medicare, Medicaid, and Medicare Part D, as well as a few other minor things, again, related to government pensions. Everything else, if you look off to the side, all those 0% and 1%, when a politician talks to you about wasteful spending, you can see that wasteful spending, while I don't like to see money wasted, doesn't add up to anything in terms of where we're spending our money. We've already made cuts to defense. That was part of the debt ceiling deal last summer. We've already made cuts to other discretionary spending and other mandatory spending. So what's left when we're trying to deal with the fiscal cliff and get our budget back into some sort of order? You have two categories left. Another way to look at it is to look at the change in the government's budget. This chart here looks at each spending category as a percentage of GDP. And you could see there are clear drops in a couple of areas. As I mentioned, mandatory spending and other discretionary spending has been cut some. You could see the big drop in the coming years, and then it does level off a little bit. You could see defense, the security line there, has gone down. And then we'll kind of maintain a flat line to about 5% of GDP, I'm sorry, below 5% of GDP, which puts us on the edge of not keeping up with some of the other superpower countries like China, Germany, Japan, and Russia. They tend to spend right around there as far as their GDP goes. And then the big areas I see, starting at the top, you see healthcare just continues to go up and starts to go up pretty significantly in the last part of the decade, as well as Social Security continues to climb. The other area that's climbing there is interest expense, and this is why the budget deficit matters. Because if we're unable to balance our budget, we have to borrow money. The more money we borrow, the more the people lending us money are going to expect us to pay an interest. And so as rates go up, the amount of interest is going to continue to increase. So if we can't balance the budget, we must keep borrowing money. And as you can see, that orange line, which is the interest expense, matches the amount of money we're spending on defense. That's $850 billion in 10 years that we'll be spending each and every year, and it will be going up every year after that. It won't be long after that before we're spending $1 trillion per year just on interest. That's money leaving our economic system going somewhere else, at the same time where we've cut defense spending. This is why the budget deficit matters. It's hurting our future. It's hurting our ability to defend ourselves. Now, there's a lot more than just the fiscal cliff that the market needs to be worried about. And you can kind of see why I get the name Mr. Sunshine, but I've been just amazed how focused everybody has been on what the Federal Reserve is doing or what the European Central Bank is doing, when they've tended to ignore all the other potential things that could go wrong. Obviously, we have the fiscal cliff that we've talked a lot about. But we also have the election coming up. And I think the election is going to tie closely to how the fiscal cliff is solved, but it's also going to be very important to how the next 2 years develop in our country. If we continue this divide that we saw the last 2 years, it's very likely that we're going to lose our AAA credit rating from the other two credit rating agencies. S&P has already said they likely cut our credit rating even more, which will then increase our borrowing costs. A lot of people ask me, well, what's going to happen if Obama wins or if Romney wins? I say that doesn't really matter, because what matters is who controls Congress. So if we see this continued divide where nothing can get done, where the Senate doesn't pass a budget again, where the House can't pass a budget, we're going to be in serious jeopardy of seeing a big decline at the beginning of 2013, or even before, if the rhetoric in the election gets too bad. We also are going to be dealing with the debt ceiling. If you recall 2011, in the summer, we had major problems in both the stock market and the bond market when they couldn't agree on what needed to be cut to raise the debt ceiling. Well, depending on whose numbers you use, we're either going to run into the debt ceiling right around the election, or at best, sometime in very early January, which means the new Congress is going to have to quickly decide what to do with the debt ceiling. Will they raise it again without any conditionality, or are they going to raise it but only if they can get spending cuts? That becomes very important. We're also going to need to be dealing with the fact that earnings growth and economic growth has slowed down significantly since we started the year, yet the market is substantially higher. Again, as we showed on those charts, it doesn't last for very long. When market growth gets to be too high and economic growth doesn't keep up, the market tends to go back down. The European debt crisis. We've spent most of this time talking about the Federal Reserve, but most experts agree that the things they've tried in Europe this year are not permanent solutions. They're just things to kind of push things back a while. Some experts are saying it only has pushed things back by about 3 months. Also, China. China is slowing down at a very rapid pace. Now, they still have strong economic growth, but when they were growing 12 or 13% per year, and then they're only growing 7 or 8%, it hurts not only their people and their ability to loan money to Europe and the US. Now, China is one of the biggest purchasers of our debt. It also hurts as far as any companies that do business over in China are relying on that type of growth over there. And then finally, we have the Middle East conflict. We saw the violence pick up again in Libya and Egypt. We have Syria, which is just a powder keg. We have rumors now that Iran and Russia are helping the side that we oppose. And if things get too ugly there, who knows? I mean, who knows what's going to happen? Russia claims to be our friend, but yet we just still can't trust them. Maybe it's because I'm a child of the 80s, but it always worries me when you see Russia on the other side of that we're on. And then, of course, you have Iran and Israel. There's still rumors that Israel wants to strike Iran before the election because it would force the president to help them. If it's after he's been elected and he's still in office, Israel feels like maybe he would not support their mission to Iran to try to prevent them from getting nuclear weapons.